morning, everybody. It's 10 o'clock. Before we get started, I'd like to thank everybody for having the confidence in me to elect me in absentia last meeting. I promise to do my best. So let's call the meeting to order. Item number 2 is the swearing-in ceremony for Regina Story. Have Francis do the oath.
Right hand up, raise your left hand, and repeat after me. I state your name.
I, Regina Story,
Do solemnly swear
do solemnly swear
that I will support, obey, and defend
that I will support, obey, and defend
the Constitution of the United States
the Constitution of the United States
and the Constitution of the State of Oklahoma,
and the Constitution of the State of Oklahoma,
and that I will not knowingly receive,
and I will not knowingly receive,
directly or
directly or indirectly,
any money or other valuable thing
any money or valuable thing
for the performance or non-performance
for the performance or
of
non-performance
any act or duty
of any act or duty
pertaining to my office
pertaining to my office
other than the compensation allowed by law.
other than the compensation allowed by law.
I further swear
I further swear
that I will faithfully discharge my duties
that I will faithfully discharge my duties
as trustee
as trustee
for the Oklahoma City Employee Retirement
for
System
the Oklahoma City Employee Retirement System
to the best of my ability.
to the best of my ability.
Congratulations.
Thank you.
Welcome. Glad to have you.
Yeah, I would want to welcome you also and let you know that the compensation allowed by law is not very much. I just want to clarify that and make sure we set your expectations right. But I do appreciate your interest in serving on the board.
Okay, item number 3 is a resolution of recognition for W.B. Smith for his dedicated service to the OCERS. Francis, will you read the resolution, please? Yeah. Well, W.B., come on up.
We're going to make you read it.
Whereas William B. Smith was elected as a trustee of the Oklahoma City Employee Retirement System to serve beginning July 1st, 1997. And whereas William B. Smith was elected vice chairman January 1st, 2003, and served as vice chairman until June 14th, 2004. Whereas William B. Smith was elected chairman June 15th, 2004, and served as chairman through June 30th, 2015. Whereas William B. Smith was awarded the Certificate of Achievement in Public Plan Policy from the International Foundation of Employee Benefit Plans for knowledge and expertise in the field of public pension plans. W.B. Smith has always had a keen interest in public policy and a strong commitment to the betterment of the Oklahoma City Employee Retirement System. Whereas W.B. Smith has performed his duties as trustee with excellence and in the best interest of Oklahoma City Employee Retirement System members and beneficiaries, and he will be greatly missed. Now, therefore, be it resolved by the Oklahoma City Employee Retirement System that the fine contribution of William B. Smith as trustee be acknowledged, and he is hereby commended for his continued public service.
Motion to approve. Second. What? All in favor? Aye. Motion carries. Thank you, sir.
Mr. Chairman, if I could make a comment, please.
Sure.
I was absent the last meeting, and I, too, just want to personally thank you for your service and your leadership. I think sometimes as employees we take things for granted regarding our pension, and we think it just will always be there, and it just is, but it requires a lot of thought and strategic thinking and planning for the future. And I think a lot of where we are now as a city and our pension is due to your leadership, WB, and I want to express my personal appreciation to you for that. Thank you.
Thank you, sir.
I'll second that. Thank you, WB. The next item, item number 4, is to approve the minutes of the meeting of June 11th, 2015. Have motion and a second. All in favor? All opposed? Motion carries. Item number 5A, to receive the report of judgments for the month of May 2015 in the amount of $155,924.77. Motion and a second. All in favor? All opposed? Motion carries. Item number 6, ratify approvals for payroll for the month of June. All in favor? All opposed? Motion carries. Item B is the agreement with ACG to assist with the Oklahoma Public Funds Trustee Educational Conference, September 23rd through 25th, 2015.
I don't know if you need any comments. This agreement is just to allow us to handle money because all of the other, well, you and other attendees send checks to us, so just so everything's straight, we need a contract for that.
Right. Motion a second. All in favor? Aye. All opposed? Item number 7 is to approve the claim docket. Motion a second. All in favor? All opposed? Item number 8 is to approve the following applications for service retirements. We have 1, 2, 3 items, applications. A motion and a second. All in favor? All opposed? Item number 9 is to receive the report of death and authorize the payment of the $5,000 death benefit and approve continuation of the pension to the spouse. Motion is second. All in favor? All opposed? Item 10 is to receive the report of death, authorize the payment of the $5,000 death benefit, and authorize the Secretary to make changes to conform on the following. Your motion? Motion is second. All in favor? All opposed? Item number 11, receive the report of death, authorize the Secretary to make necessary changes to conform on the following. Motion is second. All in favor? All opposed? Motion carries. Item number 12 is the investment consultant report.
Thank you, Mr. Chairman. I'd be remiss if I also didn't say what a privilege and honor it has been to work with W.B. Smith over these many years. Just hearing the motion and the recognition, and to hear he's been on this board since 1997, I think that's testament to the fact that this board has made good decisions and thinking about this is a long-term pool of money. We sit or work with a number of different pension boards. I think not just WB, but the way this entire board operates, a lot of folks could learn some things just in terms of thinking about the future and planning. So, again, just want to say what a privilege it's been, and welcome to Regina. This morning, I thought it would be appropriate to bring a piece just on our, talk a little bit more about what's going on in the world, because there are a number of things happening in the news that we haven't really had for the last few years. It's been a really kind of benign environment, and we've seen since 2008 markets, particularly domestic equities, going up, 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 and as we know, that doesn't continue forever. So just to highlight some things, if you look at this piece, it's amazing to see how much things have changed. Just turning to the second page, this is just ranking across 3 broad asset classes: global equities, global fixed income, and global real assets, the best subcategory year-to-date to the worst within each of those categories. This is as of June 30th. Things have changed dramatically since June 30th. So Year-to-date through June 30th, the EAFE benchmark was up almost 6%. So that's international developed stocks being the best performing area. Well, that's changed over the last couple of months. Still positive through yesterday. The EAFE benchmark is up 3, but given up almost 2.5%. Russell 2000 still up a little over about 4.3%. Emerging markets now year-to-date down 1.2%. Much of that is China. China has sold off over 35% in the last 6 weeks. You may recall a couple of months ago, I guess it was the April or May meeting when Wasatch and Von Tobel were in, we were looking at the March numbers, and through March, Wasatch and Von Tobel were significantly ahead of that emerging market benchmark. April was a month that China really took off as there was some loosening of standards as far as getting into the Shanghai benchmark, and the Chinese stock market really took off. Well, it's cooled off dramatically since then, had a massive sell-off. So your managers that didn't really participate in all of that up months because they were very underweight to China due to their concerns about just the issues with the Chinese stock market, they've benefited from preserving capital in that time period. On the fixed income side, further on equities, the S&P or large cap U.S. stocks have actually gone up a little, a little over 2% now year to date. So they've been positive in July prior to yesterday. This is really through Monday. Fixed income. Now the Barclays Ag has gone positive for the year, as you've seen interest rates come down during this volatility and the concerns over China, concerns over Greece, and other issues. You've seen a flight to quality into U.S. Treasuries, pushing up the Barclays Ag to positive territory now. The one that really stands out is oil. Year to date through the end of June, oil was up 11.6%, coming off of steep declines in 2014. Through Tuesday, oil is down 1.76 year to date. It's obviously highly volatile. You've got Iran coming back online potentially, a lot of more oil flooding into the system that already has an increase in supply. Other real asset classes are continuing to be negative for the year. One thing that you don't see here, and I looked at because the market really started to turn on June, like the second to last day of June, the last couple days of June. And it was dramatic to see the one-year numbers. Now, your fiscal year is not June 30th, but for those plans that fiscal years are June 30th, they'd be much happier if their fiscal year ended June 27th than June 30th. It was about a 2% differential for the S&P 500. Those 2 days was about a 2% differential in the one-year return for the S&P 500 and over a 3% differential for the Russell 2000. So if you figure you have 30 to 50% in U.S. stocks, and that 2.5% is, that's about, you're losing 2% on your annual return. So that's a big deal, just from a timing standpoint. Nothing really changed, and other than taking off a good day from last year and adding a couple of bad days. Just want to touch on a few things and really get to the themes at the end. But major things that we're talking about, just turning to page 4 at the bottom, issues or concerns. I walked in and was talking to Randy and starting this conversation. There is a lot of news. It is a lot of noise. In the immediate term, there is going to be impacts to the markets. We saw it yesterday, not just with the issues, the technical issues that the New York Stock Exchange was having, but the markets selling off. There's a lot of uncertainty about what's happening in Greece, certainly a lot of uncertainty about the Chinese stock market and what's happening. That said, we think there's some bigger issues, and the important thing to consider is that this is a long-term portfolio, and you have things in place already to protect you in periods like this. The overriding philosophy in the construction of this portfolio is to participate in up markets, but to protect in down markets, so you're not down as much when markets go down. And that's benefited you over time. You're not, you're trending along at close to your 7.5% return bogey over time, certainly over the last 5 years. You're well above that at 11%, but we know in periods of time when markets are down, you're not going to be down as much. So a couple of things, just potential areas of value today. These areas of value are also, we know, potential areas of volatility and concern. Emerging markets, we still like emerging markets, despite how difficult it's been over the last year. We do believe that there is going to continue to be quite a bit of dispersion. Not each emerging market is the same. So having managers that are really focused on security selection and focusing on internal demand or domestic demand within emerging markets, we think is going to continue to be important. Because what we're seeing is the indexes are coming down. It's really led by some of the big global national companies that are in that emerging market index, not necessarily the smaller companies that the Von Tobels and Wasatch are investing in that are taking advantage of growth in India specifically, or in Turkey, or in Mexico, these smaller countries.
Jason, a question, please. Are any of the emerging markets declining into what we would call the frontier markets, or any of the frontier markets moving up?
That does happen from time to time. I mean, one example is Greece is no longer a developed market, so that has come out of the EFI benchmark and is now in the EM benchmark. And it's a matter of, that's more of the MSCI or the benchmark provider, their definitions. Your managers will start with the universe or the countries that are in the benchmark, but they're not limited to that specifically. They can move in and out based on what they think the quality of the company is, although neither Wasatch or Von Tobel are really participating in frontier markets. Other areas of value, Europe and Japan, we think fundamentals there are improving despite what's going on in Greece, which we'll get to in a moment. Europe and Japan are a lot like where we were 6 years ago in the U.S., pumping a lot of money into the system, and from a stock market standpoint, we saw what that did domestically to the markets, and prices are fairly depressed. Greece, while my particular concern is we're taking an entire family back to Greece in 2 weeks, for 20 of us going for my father-in-law's 80th birthday to his village. We don't know if we'll be taking U.S. dollars or what we're going to be spending when we go there, if we're going to be trading feta cheese for food. I'm not really sure. But all in all, while there is a lot of volatility around this and the outcome is pretty unknown, it seems to be the contagion of this seems to be fairly well contained, although there is significant incentive for the European leaders to hold Greece's feet to the fire and keep them in the EU, because if it did spread to, if the political will of Spain, Italy, Ireland, Portugal, some of the bigger economies were to be bolstered by what the Greeks are trying to do, that would have a much greater impact. But just to put things in perspective, you think about the Chinese stock market has lost, I think the number is 3.4 trillion in the last 10 weeks. That is 10 times the GDP of Greece alone. I don't think that's being talked about near as much. The GDP of Greece is less than Detroit. So when Detroit went bankrupt, it had some repercussions in the domestic market, but it didn't really impact global markets dramatically. It was fairly well contained. More importantly, the debt is really contained to sovereign debt held by other governments and not necessarily private institutions or banks, like the issues that we had here in the U.S. in 2008. So it seems fairly well contained. Just flipping forward a few pages, I'm not going to go through all these charts, I've just touched on it. But the other area that we think is important to keep in mind, and it gets to this just ebb and flow, we do believe U.S. equities are due for a period. We say underperformance, debated about this word. Underperformance means in relation to something. So we're saying relative to foreign markets, we think the U.S. equities are going to underperform. Not necessarily predicting a recession with this or anticipating that, but we do think U.S. equities will sell off some. There's a number of technical signals, things that are improving in the real economy, wages going up, employment going up. That tends to have an impact on the stock market eventually. So corporate profitability is being squeezed at this point because wages have really gone up, and so that's going to put some pressure on corporations. From a technical standpoint, you've seen margin debt peak and start to come back down. Historically, when margin debt and investment accounts peaks and starts to taper down a little bit, that has been a precursor to markets selling off a little bit. And just overall valuations, we talked about valuations in Europe and emerging markets in Japan. Those valuations relative to historical look much more attractive than U.S. markets do at this point. So finally, what I really wanted to get to was the themes on page 11. And just the intent of this is really just to remind you all that despite things going on in the markets, your portfolio is constructed to address factors that are happening. You have a dynamic portfolio that the overriding theme, again, is participate in up markets, control downside losses so that over time your assets compound at a greater rate. But the 5 major themes, these haven't changed dramatically over the last year, but these are really looking out 3 to 5 years. Muted return expectations. We're in a very low return environment. Sovereign yields, U.S. 10-year Treasury yields still about a little over 2% today. Even with normal risk premiums for equities, if you put a 6% risk premium on that 10-year Treasury, you're still at about 8%, which is below historical averages for U.S. equities. Still in the neighborhood of where we would expect equity returns to be over the next 10 to 15 years, around 8%. But the next 5 to 10 years, probably a little bit lower. So what do we do about that? We say revisit strategic allocation and objectives, add faster growing markets. You've done that with the addition of emerging markets. Maintain disciplined rebalancing so we don't let small cap or large cap just run up. We take from the things that have done well and we rebalance into things that haven't done quite as well. Consider opportunistic strategies and global mandates. You're doing that. Your fixed income portfolio over the last several years, we've made it much more opportunistic in the ability for managers to do some different things. The same within the equities, the global long short. Now you're seeing, K2, your long short equity strategy, we've talked a lot, there's been headwinds because equity markets have been up, so long short equity or hedged equity has been somewhat of a drag. It hasn't been losing money, but it's been a drag relative to the rest of your portfolio. I think today, as you look at the long short returns, it's really a testament to fundamentals do matter now. Long short equity is really the best proxy for active management or managers focused on fundamentals, and we're starting to see that win out more recently as your long short over 1 year is up almost 8.4%. That's outperforming the S&P. It's outperforming the Russell 2000, outperforming international stocks as well. So that ability to do some different things, be more opportunistic is helping. Geopolitical and policy uncertainty, I think that this is a theme that never changes. We always have this concern, not knowing what's going to happen with whether it be Greece or ISIS or floods or other things going on. And that's why you have hedge components in your portfolio over time. The desynchronized global growth expectations becoming more apparent, the currency issues. There is huge dispersion in currencies today. Having managers both on the fixed income and equity side that can try to exploit that, which you do with a Brandywine on the fixed income side, and certainly your international equity managers being opportunistic and moving in and out of areas. Fixed income market headwinds, this really gets to just lower yields, very low yields, and potentially rising rates. We've done a lot within your fixed income portfolio over the years to really broaden out the mandate. Some of these things sound similar, but what you have done is provided much more flexibility with your managers to be able to mitigate some of these potential risks. The PAMCO strategy, the low volatility hedge fund strategy. Again, that was certainly a headwind in 2014 as interest rates were coming down dramatically from the beginning of 2013. But now as we look at that, as interest rates have come up a little bit, but also their ability to do some different things, that has helped relative to long-only markets and particularly bond markets. So PAMCO strategy year-to-date is up almost 3.5%, where the Barclays Ag is negative year-to-date. So very little correlation, but still very low volatility. The one thing that perhaps has changed a little bit, we've modified the language, is just an uncertain global inflationary environment. We still believe over long periods of time for a pension fund that has an infinite time horizon, inflation is a factor. But now, intermediate term, the inflation expectations are more muted. So we still think you should have inflation protection. I know we've implemented commodities recently. You have real assets. A lot of the purpose of that is to mitigate against inflation. We're not seeing a lot of it right now, or hardly any. But the real estate does have an income component that is providing a premium to your fixed income. Commodities, we think they are appropriate. They do add significant diversification. We wouldn't change that, but that's why it's such a small allocation overall in your portfolio, under 5% today. So the purpose of this was just, while these things are going on, a lot of times people have questions, well, what does it mean that the Chinese stock market has fallen 30% in the last 6 weeks? What does it mean that of what's going on in Greece if there's a Greek exit of the euro? Well, I don't really know what it means. It's not good for the markets in the short term. It creates a lot of volatility that we haven't seen over the last several years. But your portfolio is positioned. That's why you're diversified. That's why you maintain a disciplined rebalancing process, and why we continually review the overall allocation and review managers. One of the things I think we'll start to see, and we are, is relative performance of active managers starting to look better. The last 5 years it's been difficult for active managers, and it's interesting. I've sat in some board meetings and I've heard questions like, well, when do you think your performance is going to improve? And I hear managers talking about improving performance. And realistically, what they're saying is we should be able to beat the benchmark by more, but in reality, the absolute returns are going to come down. I mean, equity managers have been getting in the 10 to 20% returns because equities have been up that much. But it's been you might be up 20 and your benchmark's up 23. Well, now when the benchmark's up 6 or down 5 and you're down 2, you're outperforming, but the absolute returns aren't as good. So you also need to be careful what you wish for, what you're asking for. But we expect that over time for active management really to do better in periods of more difficult times. So enough on that, unless there's any questions, but I just felt it important to address some of those things going on and just remind the board of how you're positioned. So as we look at the actual report through June 30, you see on the first page the asset allocation relative to targets. Still remain a little bit overweight to small cap, and we've been using small cap to meet your operating needs when you need cash the last couple of months, and we would anticipate keeping that in place for the next month as you go forward. So looking at Times Square and Earnest as sources to rebalance from for cash needs. But overall, equity is about 2% overweight overall equity, and again, that's coming primarily from small cap U.S. and a little bit from large cap U.S. Long short is in line. Private equity remains slightly underweight as that program takes time to get funded. Probably in the next couple months, we'll be coming back with an update on the private equity program and some recommendations for some potential new commitments. Is that something that needs to continue to be funded? The fixed income is about 1% overweight. So your fixed income and equity slightly overweight. Real estate is underweight by 3%, and that's that opportunistic piece. Much like the private equity, opportunistic real estate is in closed-end funds, and you fund that over time. That's something that we need to continue to add to. So just turning to the top of the next page, actual returns. The one-year return for the total portfolio is a little over 4%, and that's gross. That's before fees. On a net of fee basis, the portfolio returned 3.44%. Your policy index, or what your asset allocation would suggest, is up 3%. So on a one-year basis, while not meeting your required return threshold over that one-year period, the portfolio is outperforming both gross and net on a relative to your policy index, as well as on a three-year basis. Three-year basis, you're up 10.8%. The total portfolio net of all fees relative to the policy index up 10.2, and relative to your required return of 7.5. So very good returns still over the last 3 years. We just added that net of fee. We've gone back 3 years to show that. We don't have longer periods of time, but we're now updating that going forward. So, really, from a asset class standpoint, with the exception of fixed income, real estate, your real asset composite is hard to judge right now because the numbers we don't have benchmark for the Odyssey updated through June 30 because there's a lag with that. But if we look at each of your asset class components, everything is really adding to that outperformance of the policy index. So large cap equity up 8%, so that's the combination of State Street and Intech. So your large cap is primarily passively implemented. Large cap is an area where we think there's a lot of efficiencies in the market, very difficult for managers to add value net of fees. So that component, while your largest allocation is implemented primarily passively, although the Intech strategy does have an active component to it, they're going to be very benchmark aware, and the construction of that portfolio won't deviate significantly in terms of the risk positions from the benchmark, but they do seek to add 75 to 150 basis points of excess return over a full market cycle, and they've certainly done that over the last couple of years. The one-year return for Intech is almost 9%, where the Russell 1000, their benchmark is up 7.3, so they've added 150 basis points there. So a lot of the excess return in large cap coming from Intech. Your small cap portfolio, this is the combination of Times Square, which buys small to mid cap stocks on the growth side. They're a growth-oriented manager. And Earnest Partners, which is a SMID manager, has a value bias, but they tend to look very different than a lot of value managers because they really avoid REITs, which makes up a big percentage of the Russell 2000 and 2500 value. And so they tend not to, their returns tend not to look like the benchmark. So when REITs are doing well, they tend to lag. When REITs are selling off, which they have more recently, they tend to add pretty significant excess return. Philosophically, they just believe you're buying real estate in other areas of portfolio, and a lot of times they're not. It's more of a yield play than a value play. That's certainly benefited. From a styles perspective over the last year, you don't necessarily see that in these numbers, but the dispersion between growth and value is also huge. Within large cap and small cap domestically, growth has significantly outperformed value. The Russell 2500 growth index is up 11.3%. the custom index for Ernest Partners, which today is the Russell 2500 value. We call it a custom index because going back in time, we transitioned this portfolio from a small to a SMID portfolio. So historically, it's a combination of the Russell 2000 value and the Russell 2500 value. But today, it's all SMID. That benchmark's only up 99 or 1% for the year. So there's about a 10, almost 11% differential between growth and value in small cap. But so Times Square did better on an absolute basis than Ernest. They're up 8.3 versus 5.8, but the Times Square trailed their benchmark. Very difficult to beat that bogey. Ernest outperformed their benchmark by almost 5.5%, but trailed your growth manager. So you see the balance between the two, that they offset one another, but they do complement each other well. The long short, which I mentioned, K2, this is a hedged equity strategy. It's all equities, long and short, really intended to be an insurance policy to mitigate equity market volatility. Will tend to lag when markets are up and do a little bit better in sideways to negative market environments. So we compare that to the HFRI fund-to-fund strategic, which is made up of other directionally oriented hedge funds. I say directionally because it's not all equity oriented, but primarily long-short equity oriented hedge funds. They've got about double the return over the last year, but more importantly, that 8.38% return is more than the S&P over that one-year period, which we haven't seen. But as markets have gone down, particularly in the last couple of months, or trading sideways, the long-short has really done what we would expect it to do. Private equity, it's a very good year within your private equity portfolio. This is going to lag other parts of your portfolio. It's not going to track anything because it's private market investments. You've had some things written up, gotten a few distributions. This month, you've got, this is on the last page, or second to last page, 5. The cash flow activity for 1 month, you got some pretty big distributions back. So this would be your private equity funds selling companies and sending the proceeds back to you. So that cash inflow, that means coming back, a distribution back from the fund of $527,000, and that's spread across 2 different funds, Mesero, and then the Warburg Pincus had a couple of distributions, and then one capital call where they took money in and invested it.
On the private equity side, can you remind me how that works as far as logistics of, so you've got firms that they're sending money back and we still haven't, they haven't fully called our commitment. Mm-hmm. How does that work in that exchange? Well, I mean, is it basically we just take, it doesn't net out, it's just we receive that?
Sometimes, and I don't know exactly if that one, there's an example of that here, but if they're only calling money down when they're making an investment, so they're not holding cash.
Right.
The funds or the funds that you've committed to them are in the pension plan until they call for them to make an investment. When they sell a company, they then make those distributions back to you. It's not recycled into the fund like dividends or interest would be in a large cap fund or a fixed income fund. If a manager has an investment to be made at the same time that they need to distribute, and they also have sold something, they will net out in a capital call. So they might say, at this time, we're making a distribution of $100,000 from sale of proceeds of XYZ company. We're also making a capital call for $50,000 to make an investment in ABC company. The net capital call is the difference, and that's what come back to you. So you don't necessarily. So from an accounting standpoint, the drawn to date column that we show on page 5, we have committed, drawn to date. So you've committed $32.5 million to these 3 funds. They've drawn almost $21 million. That doesn't necessarily mean you've sent them $21 million because some of it could have been netted where it's just you're not necessarily getting there. that's what that would be comparable to your cost. It's not exactly cost because some of that goes into fees and other things, but it's comparable to that. Just quickly finishing up, international equity, while negative, your managers, this is Lazard and Harding Loevner. Lazard's kind of more of a value bent, Harding Loevner growth. Slightly negative, but really protecting in a negative market environment. They're down 14 basis points on a 1 year, where the EFI benchmark is down 3.8. Emerging markets, here you have two managers as well. They're not growth and value. Vontobel is broader emerging markets, all cap within the emerging markets. They tend to have a high quality bias, really going to have a significant overweight at all times to consumer staples. It's really that play on domestic demand in emerging markets, so buying companies that sell beer in Mexico, diapers to China, consumer goods and branded goods in India. They just believe that that keeps them away from slowing global growth that might reduce demand from developed countries for buying more commodity-oriented stocks or goods from emerging markets, and that's done well for them in periods like this where things get a bit more challenging. And then Wasatch is buying emerging market small cap companies, so they're much smaller, but again, a similar theme, and that's held up well. Finally, the fixed income trailed the ag a bit. That's primarily while we say the diversification has helped on a 1 year basis, I think it's the Brandywine strategy, been a lot of volatility there relative to the ag. Brandywine not benchmarked to the ag, but they are a global bond manager buying non-U.S., primarily non-U.S. sovereign bonds. Currency has been an impact there, particularly relative to the ag, which is the policy index component. As interest rates have come down, treasuries have done well, but Brandywine, relative to its own benchmark, the Citigroup World Government Bond Index, has actually outperformed by almost 4%, but down more than U.S. bonds during that period. So that's been a headwind. So overall, while there's a lot going on in the markets today, I think it's been, I don't want to say it's been an easy 5 years, but it's a lot easier standing up here and talking when markets are going up. But we've done things in the portfolio to have diversification and a discipline for periods like we're going through, and I think it's going to be continue to be a bit rocky going forward. But the portfolio construction we think is appropriate. The managers that you have certainly tend to be more defensive than others. You don't have some real high flyers in this portfolio.
Any questions?
On our allocations, Jason, when we're talking about real estate being 3% below our allocation target, and you said that that's something that we need to keep focused on, have our commitments that we've made in real estate, will that eventually balance that, or is it something that we need to take more action on?
Well, it's like the private equity, because if you note, it's really the opportunistic real estate, which is they're the same structure as private equity funds. So currently, you have one commitment there to the TA fund. You, in December of 2012, made a $5 million commitment. They've drawn $4.75 million. So that's an area we need to add to that. We need to add, but it's really more a function of when opportunities are available. It's not, we don't want to just force it out just because you're underweight there. We want to look for good firms that are coming to market that have a good opportunity set. So we'll bring that back to the board. Continue to build that out.
Thank you, sir.
Thank you.
Item number 13, any comments from board, staff, or citizens? I would just note that if anyone is planning on attending the Oklahoma Public Funds Trustee Conference in September and hadn't let Renee know yet, there's no time like the present to do so, so she can get that all buttoned up.
I want to say I'm very excited about this opportunity. I just wanted to let the board know I look forward to working with you, and I hope I can bring some kind of my background and skills to this. No, I'm not going to be as wonderfully received as my predecessor, but I just hope to be able to contribute something. Thank you.
Thank you very much. Glad to have you. If we don't have any other comments, we're adjourned. Thank you.